here. Take a look. Bitcoin yesterday, what a collapse, dropping from 73,000 to 60,000 at the lows down here before snapping back to 66,800 currently. Now, before we get into that, let's talk about how I was able to call the top back in 2025 in October. Very simple here. We're going to flip over to the weekly chart. We're going to zoom out until we can see the 2017 bull market. Now, the beauty of this, folks, is as a technician, you trust the charts. All right. While everyone else is hyping things up, you simply trust the charts. And what we can see here is if you connect the high from the bull market of 2017 to this high here in 2021, look at where we kept hammering once, twice, thrice before the big turndown. And so while you were getting those crazy targets of 250,000 by year end in 2025, I was saying, guys, I'm short Bitcoin. The top is here unless proven otherwise. How would it prove me otherwise? Well, if it broke through this trend line and confirmed, then okay. Then it's broken. It's just that simple, right? But it didn't and it hadn't, so I stuck with the short. Now, as it came down, we got this beautiful, let's go back to the daily chart, the beautiful bear flag I gave you guys a while back. And the whole time this was going on, I said, guys, be careful here. This is a bear flag off of this down move, right? So in technical analysis, we have a drop, let's say a stock drops or a crypto drops, then you get this sideways chop like this. That's bearish consolidation. The ultimate result is that. Look at how that was exactly what we saw here, right? And then that flush. Now, the bigger question is, are we in? Is a low in? Is a cycle low in? The answer is no, most likely not a cycle low. But I did still go long Bitcoin, and I'm still holding Bitcoin long because I do think it's going to bounce substantially. All right, it's already started to bounce. I think it's going back to at minimum 75,000, and I'll show you why I think that. All right, so if we look at this chart, right? So first of all, as we collapsed, let's talk about where we came into. And this is a level I've talked about for quite some time. If you go back, we talked about basically anything in the 70 to 60,000 range as being technical support. Now, why? Why was that a major level? Well, number one, we could see that we had these highs over here, right? Right around 70,000, there was this high, and you had your 69,000 bull market high from 2021, right? So if we start there and we drag it down, we can see again, and then we drag this out, it goes right into the high pivot here. So lots of, and think about this, right? So as a technician, you have to understand there's a lot of support here. There's a lot of support here. And there's just tons of support in this range, right? Because look, from both sides, there was so much price action and chop. And so that creates a range of major technical support. Now, the fear was so dramatic yesterday, and this was, I mean, listen, the fear was palpable that, as Bitcoin was collapsing, like you could feel it in the air amongst crypto investors. And I get that. I could feel it, right? But in essence, fear is where bottoms are made in the short term, at least. And we always have an old adage on Wall Street that said, when there's blood in the streets, that's when you buy, meaning when everyone is panicking, that's when you buy. And you use the charts to your advantage, right? So we charts in here. All right. So ultimately, as we've come in here, now we're starting to get a bounce. Now, let's talk about why I think we bounce back to 75,000. Well, really what you recognize here is that we have pivot lows right in this zone, right? And so again, you can see this low, this low, this low. We broke through that. So if we put a trend line in, let's do a trend line here. And let me actually erase that so we keep it as clean as possible. If we put a trend line right in at this low, what is that? That's around 75,000. And then we have these other subsequent lows right through here. All right. So again, generally 75 to 77,000 is what you would expect the bounce back to be. Now, could it be a little bit bigger than that? Sure. If it breaks through this level, it might even test this 80, 81,000 level. That wouldn't be outlandish. But the problem here is, and this is where unfortunately crypto investors are along for a ride, right? Just like in a way we're seeing silver investors along for a ride, right? Stock market yesterday after the bell, Amazon started to drop. Silver was dropping massively. Silver went back to like $60 per ounce on silver. It's bounced back because the stock market has bounced back. But the same thing with crypto, right? So while I still believe, listen, that this narrative, they're trying to kill the narrative that it's a digital gold. I still don't think it is right now. And I've said that for a long time. It's a risk asset and it's a leading indicator of a risk asset, which we can see very clearly as the stock market starts to come down from its near-term all-time highs. But Bitcoin made an all-time high 5 months ago, right? But I still think it eventually morphs into a digital gold. And so longer term, I still think Bitcoin makes new all-time highs and keeps going up. But in the near term, you have to understand the stock market is going to dictate. When the stock market drops sharply, Bitcoin likely is going to lose its luster and drop as well. Going back to the charts, we have our upside bounce target in the near term, 75 to 77,000. If it breaks through that, this pivot low at around 80 to 81,000 could be tagged. Now, what would I be looking for? So let's get rid of all of these arrows here. We don't need them at this point. But basically, if we continue down, all right, where could this go? And this is where we start. I'm even going to remove these other lines. This is where we talk about that worst case scenario, right? Where you have a shoulder, head, shoulder. And I actually think there is a chance, and again, I deal in a world of probabilities, right? So, when I'm talking about a chance, it's probably about a 30% chance, maybe 35% chance that Bitcoin goes down to about 35,000. All right. Now you might say, well, wow, why would it go down that much? Well, because the head and shoulders target is there. And if the stock market, right now the stock market's like 5% off its all-time highs. Just imagine if the stock market goes down 10 or 15%, 20%. If we hit 60,000 and we're down 5% on the stock market, you're telling me if we go down 15 or 20%, Bitcoin can't go down to 35,000. We may not want to admit that, but it is possible. And past bear markets have seen drawdowns of 70, 75, 80%, right? And so in essence, if we look at that and we map that out, so number one, let's first put in our head and shoulders. We'll use the actual tool for head and shoulders. You have that. If you have trading view here, you have that ability. So here's your shoulder, head, okay? This was your breakdown. There's your collapse. So this triggered, all right? Now, to calculate your target, what you do is you take your highest point of the head, which is actually over here. We drop a plumb line to that neckline, which is connecting this point to this point. This is called your neckline, all right? And then you map that out, meaning you take that same distance, and from the break of the neckline, that's your target, 35,000, right? Now, again, what's interesting here is if we look at how far of a drop would that be from the all-time highs, that would be a 72.5% drop, right in line with past cycles. Now, again, I've been a proponent to say that because institutions have gotten involved, that the bear markets won't be as deep. So this would kind of go contrary to what I've said. And I still do believe that to some extent. But I also think we are on the cusp of a bigger bear market in the stock market, one that could see a drawdown potentially of 20% or more. Like, obviously, we've seen bear markets in 2022 that had a drawdown in the stock market, but it wasn't like a crazy panicked bear market. It wasn't like we were in a recession, right? If we get in a recession, and we saw the Challenger jobs numbers recently, right, just yesterday, those were not good. Jobless claims are starting to spike, people filing for unemployment. We know that the majority of GDP is so strong because these companies, these AI companies are basically funding all of the GDP. Like Amazon announced they're going to basically spend $200 billion. I think Google/Alphabet said $170 billion this year. All these other, Microsoft spending a ton. All of these companies are spending, basically $1 trillion in spending just from these big AI companies. That's going to fuel one small area, maybe a growing area, but to a lot of us out there, you're not seeing the benefits. I'm not seeing the benefit, right? It's very niche. And so you can't really trust, in my opinion, the GDP, which is like ridiculously high right now, like 5%. You can't trust that. What we look at is obviously now we're starting to see layoffs increase. The labor market's basically stalled out, probably starting to see unemployment go up. And I am concerned that inflation could start to move up based on copper being at all-time highs or just off all-time highs. Silver obviously had that big surge. It's come in, but it's still above where it was, a few months ago. These are all inflationary signals in the near term, which is going to make it harder for the Federal Reserve to cut rates. I still think the Fed will cut rates, especially with these jobs numbers getting a little bit weaker. But again, it just creates a scenario getting back to Bitcoin where ultimately Bitcoin does have a chance to go down here. Now, again, you say, oh, Garrett's saying it could go down here, but he said he's long. Well, yeah, because I'm playing for the bounce, right? I play for a bounce back to, we talked 75, 77, maybe 81. What's interesting, the neckline of that head and shoulders is right around that 81,000 level, which would be a retrace to the breakdown point. So all of those are potential levels, but once we get there, I will lighten up. Now, listen, I still will hold on to my hodl position. I have a small Bitcoin position that as it goes lower, I've been adding just a little bit. I tuck a little bit away for the longer term. Nothing crazy, just a little hodl away. And if it comes down again, it goes below 60, guess what? At 55, I'll add a little bit. At 50, at 45, at 40, at 35, at 30, etc. I'll just continue to inch in a little bit more. Again, as a student of trading and investing, I do smaller areas based on risk, but nonetheless, I continue to want to do that. So, all right, the point here, folks, is Bitcoin near term, it looks like a bottom. The last thing I'll show you guys is the volume yesterday. Volume and panic are an indicator, and they go hand in hand. And if we look at the volume on Bitcoin, I don't know if you guys can see this. This is the volume candle here. It's kind of blends in with the red, but you can see right here. Look at the size of the volume. The volume candle yesterday on Bitcoin, folks, was the biggest volume candle in literally, I mean, you look at this. When was the last time? Wow, the last time volume was this high was at the low in 2024 before this move. So volume, and the reason why is volume important for us? The volume is important because it tells us there's a lot of fear and panic. People were panicking. Liquidity was getting, all the leverage was getting flushed out. And those are all signals that, again, essentially there's blood in the streets.
We'd be looking at markets.
Well, we are seeing a little bit of a retracement bounce, Diane, after this aggressive sell-off over the last couple of days. And this is kind of not surprising. Actually, if you look at the technical setup on the S&P 500, we basically closed at the 100-day moving average yesterday. Now, we have seen this in the past around 3 times since the April lows here. And usually the next day, we actually do see green on the screen. A lot of these moving averages, we usually do not flush through them the first time and see kind of this massive move to the downside, unless we have an exogenous event. So I think this is a technical bounce back here, at least for today. Now, if I'm kind of looking at the E-mini S&P 500 futures contracts, we did see an increase in open interest yesterday with the markets moving down. So that kind of signifies to me that we are seeing net new sellers coming into the market. And I think this is kind of a correction in time. We've heard about this term, kind of these rolling recessions. I think this is kind of a rolling correction within the market. I mean, we have seen some weakness when it comes to technology stocks. You have seen weakness when it comes to, obviously, the software names as well. But there has been some strength in some sectors that have not really performed over the last 2 years. Consumer staples continuing to make new relative all-time highs here. You're also seeing industrials a little bit more participation in that market here. And the Mag 7 names aren't trading particularly well. I mean, Microsoft is completely falling off a cliff. So I think right now this is kind of a little bit of a churn in the market. Let's see if we can hold this bounce back today. I think that's going to be a telling sign. If we actually do end in the red, that kind of means that we did see a lot of selling into strength here. And maybe we get another rally, not only just for today, but maybe on Monday before we actually start testing some key areas of resistance. But I think this churn or this kind of rotation trade actually has kind of helped us out from seeing even more destruction in the S&P 500.
Good point there. So it feels like already a theme so far this year is the rotation trade and the point you just made about rolling corrections. But let's talk about another member of the Mag 7, Amazon, out with its quarterly report card. Another big spender here in terms of CapEx for the year. Take us through some of your takeaways here.
Yeah, we are seeing the shares down. Now, it's off the lows. It actually traded down to $197. So you are seeing some buyers really stepping in here, at least in pre-market trading. Now, the company did miss when it came to the adjusted earnings per share. They reported $1.95 there. Street was looking for around $1.96. But revenue did exceed the Street's expectations, coming in at $213.3 billion. Street was looking for $211.4 billion here. And when you're looking at AWS revenue, that did exceed the Street's expectations, coming in at $35.58 billion. Street was looking looking for 34.93 billion. And advertising revenue, once again, came in better than the street's expectations. But you kind of highlighted this at the open here. The CapEx spend, they are looking at around $200 billion for 2026. Street was looking for around 146.6 billion. Now they're spending a lot of this money on trying to expand their data center presence. Obviously, this is going to go into AWS as well as chips and robotics. And so the market obviously is not really enjoying that CapEx spend, especially when the guidance is coming in a little bit light, not only for top line, but bottom line revenue. Their Q1 guide did miss the street's expectations, and their operating income guide also did miss. So the concern that analysts as well as investors have is that this ramp up in CapEx spend continues, and we do see maybe a deceleration when it comes to growth on the top line, and then also maybe pressuring free cash flow. And in fact, if it gets too aggressive, maybe even negative free cash flow, which makes it very difficult for these stocks to trade at the multiples that they are right now. So seeing a pullback, well, let's see how the market actually reacts here. We did see buyers coming in and stepping into Alphabet, Google yesterday in the open as well, try to recover some of those losses. Maybe that's going to be the same thing for Amazon this morning.
It does feel like this time around that most of the Mag 7 are being punished for the level of spending they plan to do this year, if I recall correctly, except for Meta.
The future AI, but at some point, the market cannot continue to price in the future. It can only price in the future to a certain extent. And then when it sees these numbers, it starts to get nervous, especially because we don't have a way of seeing the tangible effects of all of this spend. Now, stock prices will eventually tank to where the valuations are so low that investors are excited about the future again. Remember, I told you in my last video, Microsoft will likely go to 400, and at 400, it will be at the same forward PE as Meta was, around a 21 to 22 forward PE. And certainly, Microsoft does look attractive now from a valuation standpoint, but mark my words, it can still drop even more. Now, let's pull up my projection on SPX for this year. If I pull up my projection, I want you to take a look at something. So my projection is this. Now, I'm not saying I'm going to be 100% right. This is around what I'm expecting. Now, why do I expect the S&P 500 to drop to this level? I looked at the weekly gaps on the S&P 500, and although there are a few daily gaps that are unresolved, I could not find one weekly gap on the S&P 500 that was unresolved. This gap right here is important because this was after Liberation Day. So this right here was the euphoria post Liberation Day. We have not revisited it. Now, I don't particularly think that stocks are going to go back down to Liberation Day, but I do think that this right here is very, very plausible at some point this year. And I took a look at XLK, which is the technology sector of the S&P 500, and it has the same gap there. If you take a look at QQQ, you can see that it has the same gap there. Now go back to the weekly chart on QQQ. There are no unresolved gaps. These eventually get resolved, and sometimes way later. So if you look at this gap here from 2022, it wasn't resolved until a year later. And I gave you a ton of analysis. Obviously, my analysis is not just because there's one measly gap there. But if we are going to drop, to me, it makes sense to eventually fill that. Because if you measure the fib, this right here is on QQQ, that right there is the 0.618. This is like where the golden pocket lives. It makes total sense. You know, if you measure this move here, this was the golden pocket. If you measure this move here, this was the golden pocket. It's a very sensical area, in my opinion. Now, what stocks did I sell? I sold Tesla back in December, as I told you guys. And even in my last video, I told you that there is a short on Tesla to where? To this level here. If you don't believe me, here it is. And in my opinion, there might be a short play on Tesla here that it will likely see some pretty big volatility, and we might test these lows here in the 380s. But stocks that are high beta, Tesla is definitely a high beta stock, and it goes through waves of cycles. And I will definitely buy back Tesla at some point, but we did hit an all-time high in December, and it suffered its first year-on-year decline. Now, stocks like Google, I just did not sell, right? Because Google, I got at such a low valuation. I was buying Google during the search is dead time in the 140s, 150s. And Google is the only one of the only Mag 7s that's not involved with OpenAI. And it has the advantage of a proprietary AI related technology such as TPUs. And its valuation is still decent. So I kept Google, obviously. Same for Apple. I mean, Apple's in a different league than these other companies. It really is a consumer retail stock. It's not a technology stock. Yes, they sell technology, but most of their money comes from retail. And they didn't have an insane amount of CapEx spend. They're not spending on AI. They're partnering with Google, and they're like, yeah, that's how we're going to do it for now. Now, I want to get away from the idea that some stocks are a sell. Like if you bought NVIDIA in the 80s, like we did, then it's going to be hard for you to say NVIDIA is a sell here. If you bought NVIDIA at 180 and it's sitting at 171, you have something to consider. Also, one other thing, if you live in the United States like me, there is a difference between a tax advantaged account and an account where you're going to get penalized up the ass for tax. So in a tax advantaged account, like an IRA, you can sell and buy stuff without getting taxed because you're not taxed now, you're taxed at the point of withdrawal when you retire. But in your regular brokerage accounts, you have to also consider the fact that, are you selling? And if you are, how much tax are you going to eat? And is it worth for you to sell at this point, eat that tax, and then buy back in later? A lot of times the answer is no, depending on when you bought. Now, I must admit, in my tax advantage accounts, I did take profits on QQQ and I took profits on SPY as well, because the indices, to me, sitting at all-time highs here, with my thesis, I just don't think it's worth the risk. It's not that I don't think I can be wrong and that the indices can go higher. They certainly can, and I can be wrong, and I have been wrong. It's just about managing risk. As a matter of fact, I wrote this on X yesterday. I said, retail doesn't understand this, but when active money managers go to cash, it's not because they don't think the market can go higher. It's because the possibility of the market going higher is not worth the risk or the volatility. And that's what I see with QQQ and with SPY. Now, I do have SPY V, and I'm keeping that, for instance. But one of the things that's challenging with this market environment is there are things that are at an insane valuation. If I took all of the market stuff aside and I'm looking at Microsoft and it's sitting here at 393, again, I really can't believe that this is something that I called out a couple weeks ago, and it's actually here sitting below 400 when this thing was trading at 555. When I look at this, 30% down from highs, 22 forward PE, I don't think that you're going to lose money in the long run buying Microsoft here.